We're starting today not with a small move, but with a total collapse in one corner of the market.
A very specific corner.
WTI crude. It plunged a pretty staggering 3.12% today, settling at $55.05.
And that one move was basically powerful enough to pull the whole energy sector down with it.
Down 3.05%. And that's pretty much the main reason the Dow Jones shed 302 points today, a drop of 0.62%.
Right, but if you only looked at Dow, you'd think, okay, completely risk-off day, everybody's running for the hills.
But that is absolutely not the full picture.
Not even close. That's what's so fascinating. The real story is the counter-narrative. Underneath it all, the NASDAQ composite, it just defied all that carnage. It posted a gain of 0.23%, closing just over 23,111.
Okay, we have to unpack that immediately. I mean, the S&P 500 closed down 0.24% at 6,800.26. That's its third losing day in a row. So on the surface, it looks kind of flat, kind of boring.
Exactly.
But the rotation happening within those 500 stocks to get to that flat close, that's the whole story today. It really feels like we're watching two different markets.
We absolutely are. That divergence is the theme. The gap between the NASDAQ's gain and the Dow's loss was 85 basis points.
Which is a pretty wide split for a single day.
It's one of the widest we've seen in weeks. And it just screams that capital isn't just moving around tentatively, it's being aggressively reallocated.
So to really understand how aggressive, we have to look at the sectors. What was the spread between the best and worst performers?
The gap was just staggering. We're talking nearly 325 basis points from top to bottom.
Wow.
On the winning side, you had technology up a modest 0.18%, and consumer discretionary right behind it, up 0.16%.
So the classic secular growth in names.
Precisely. The companies that are banking on long-term trends, the ones that really benefit from the idea of lower financing costs down the road.
So they're still kind of riding the high from the Fed's rate cut last week, even if the Fed tried to sound hawkish about the future pace.
That's it. They're focused on the timing of that cut. But on the other side, the laggards. I mean, besides the obvious energy collapse, where else was the selling really bad?
Where was the pain?
Well, it wasn't just oil. Healthcare took a big hit, down 1.30%.
That's a pretty deep cut.
It is. And then real estate, another very rate-sensitive sector, fell 0.88%. So if you piece it all together, it confirms this wasn't just a generic risk-off day.
Yeah.
It was a very specific, aggressive rotation away from anything tied to commodities and global growth and straight into those secular growth names.
The market is basically shouting, we're betting on the tech story and we're getting out of anything tied to oil demand right now.
You got it. And that brings us right to the epicenter of all this, the energy complex itself.
Let's talk about that WTI decline, because it wasn't just a bad day, was it?
No, plunging 3.12% to $55.05. That did some serious technical damage.
Okay, walk us through that. What does that price level mean when you look at the longer-term charts?
It's a flashing red light. I mean, WTI is now trading a full 13.13% below its 200-day moving average.
Which is at $63.37.
Right. And when you're that far below your long-term trend line, it suggests this is more than just a dip. It's deep trend deterioration. And Brent crude confirmed it, falling 2.86% to $58.83.
So this pessimism is global. What was the catalyst? What finally broke the jam today?
It was really a mix of things, but it all centered on OPEC plus. So they made a small production adjustment for December, about 137,000 barrels per day.
Which is tiny.
It's marginal. But the bombshell was their announcement that they would pause any production increases all the way through the first quarter of 2026.
And the market saw that pause and thought, weakness, not strength.
Precisely. The market basically said that's not enough. The decision to just pause was seen as totally insufficient to deal with what looks like a structural oversupply problem.
And that was made worse by data out of China.
Exactly. The manufacturing PMI there fell to 49.9. And, anything below 50 means contraction. So when the world's biggest oil importer shows shrinking manufacturing, traders just start pricing in lower demand for the future. It's like pouring gasoline on the fire.
And of course, it wasn't just oil. Natural gas dropped 2.37% to $3.92. Just broad weakness.
The entire fossil fuel trade was under pressure. Now, here's where it gets really interesting. Because while energy was screaming slow down, the bond market was sending a completely different signal.
The counter signal, let's get into that. Yields fell. The 10-year was down 3 basis points to 4.15%. The 5-year dropped 4 basis points. Now, usually, falling yields mean growth fears, which should hurt stocks.
Right, especially growth stocks.
Yeah.
But we saw the NASDAQ rally.
So what does that divergence tell you?
It tells me that bond traders and stock traders are looking at two different things. The bond market is pricing in softer growth, which, gives the Fed more room to cut rates later. That helps the NASDAQ.
But the cyclical stocks are dealing with today's problems.
Today's problems: the oil collapse, regulatory fears in healthcare, they're fighting different battles on different timelines.
And importantly, the yield curve itself is still healthy, right?
That's paramount. The curve has a normal positive slope. The 10-year to 3-month spread is sitting at a positive 61 basis points. That suggests the bond market is, well, it's comfortable, it's not panicking, it's not pricing in some kind of emergency that would force the Fed into aggressive cuts.
Okay, shifting over to currencies. The dollar weakness we saw after the Fed meeting, that continued.
It did. The DXY fell another 0.10% to 98.21. But the really big story in FX today, and this is a global risk factor you have to watch, was the yen.
The USD-JPY pair dropped 0.74% to 154.73. That is a big move for that pair. What's going on?
It's all about traders positioning for the Bank of Japan meeting this week. We are seeing a classic unwinding of the yen carry trade.
Okay, for anyone not deep in the FX world, break down the carry trade for us.
Think of it like this. For years, you could borrow money in Japan for almost nothing, like near zero interest rates.
Yeah.
Then you take that money and invest it somewhere like the U.S. where rates are much higher. You pocket the difference, the carry.
It's a massive global trade.
Huge. But now, the Bank of Japan, the BOJ, is expected to hike its rate this week, maybe to 0.75%. Suddenly, the cost of borrowing that yen goes up.
So traders have to unwind the trade.
They have to sell their other assets and buy back yen to pay off those loans before rates go even higher. And that massive wave of yen buying is what's driving its price up so sharply.
Makes perfect sense. Get out before the event. Okay, before we look ahead, let's touch on some of the data points today that just seemed contradictory. Starting with the VIX. How does the market's fear gauge fall on a day like today?
It's the VIX Paradox, and it is maybe the most curious thing that happened. The VIX fell 0.12% to 16.48. It's still way below its 50-day moving average of 18.46.
So what does that tell us?
It suggests the options market looks at all this selling and says it's contained. This isn't a systemic problem that's going to sink the whole ship. It's just stress in a few specific sectors. The pros aren't panicking because the pain isn't spreading.
And that concentrated pain might explain why small caps were also down. The Russell 2000 fell 0.45%.
That's a key piece of the puzzle. The Russell is now almost 3%, specifically 2.95%, below the 52-week high it hit just last week. It suggests that post-Fed rally might already be running out of steam, especially for smaller companies that are more exposed to the domestic economy and, energy prices.
Right. And we also got some delayed jobs data for November.
We did. The economy added 64,000 jobs, which was a little better than expected. But the number that should really make you pause is the unemployment rate. It rose to 4.6%.
That's the highest it's been since 2021.
It is. So you have this really mixed signal. Decent job growth, but rising unemployment.
It gives ammunition to both sides of the Fed argument.
Exactly. The Hawks can point to the job gains and say the economy's still hot. The Doves can point to that 3-year high in unemployment and argue that policy is starting to bite. And the Fed needs to be ready to cut. It just keeps everything uncertain.
Let's look at some of the other assets, like crypto. Bitcoin is still really struggling.
It's just persistent pain there. Bitcoin is trading around $87,853. It's down 5.60% in the last week alone. But the big number is that it's down over 30% from its all-time high.
30.32% below its high of $126,080. That's a serious correction, even with the total crypto market cap still at $2.34 trillion.
It is. The weakness there suggests that there are pressures specific to digital assets, maybe regulatory, that are just outweighing anything else right now. It's its own story, independent of the NASDAQ strength.
And speaking of assets, let's go back to real estate. Down almost a full percent today. Why is it still lagging when bond yields tick down a bit?
Because REITs are sensitive to the long-term rate outlook, and even with today's little dip in yields, the market is still digesting that hawkish message from the Fed last week, the idea that maybe we'll get as many cuts in 2026 as everyone hoped.
That higher for longer narrative hurts their cost of capital.
Enormously. And you saw the pain in some of the biggest names. PLUNGES was down 2.33%, Digital Realty fell 1.71%.
And we also got some residential housing data.
That's right. Home prices nationally fell 1.4% over the last 3 months. Now, that's important because it's the first quarterly decline we've seen since mid-2023.
At the same time, listings are up.
Up 12.6% year over year. So, the housing market is clearly shifting. More inventory, less price pressure, A little bit of relief for buyers, finally.
Okay, so we've got this session defined by wild divergence, an oil collapse, and a surprisingly calm VIX. What does this set us up for? What are the big events to watch?
The next 72 hours are absolutely crucial. Thursday's the main event, November CPI data,
The inflation report.
the inflation report. That number is going to decide whether the market can keep pricing in a Fed cut for January. If it comes in hot, that whole narrative could just evaporate.
And then there's the other event, the Bank of Japan meeting.
Which is arguably the bigger global risk right now. That's Wednesday and Thursday. With a rate hike pretty much baked in, the question is how the yen reacts.
No.
If that carry trade unwinding really accelerates, you could see ripple effects across all risk assets.
So where do things stand technically right now? Where's the battleground?
Both the S&P and the NASDAQ are sitting right on their most critical support level, the 50-day moving average.
How close are we?
The S&P closed at 6,800.26, which is just 0.52% above its 50-day. It's hanging on by a thread. The NASDAQ is even tighter. It's basically at its 50-day, closed just 0.05% below it.
So those are the lines in the sand heading into the CPI number.
Absolutely. If that data is bad, those levels are going to get tested and fast.
So let's game this out. What's the realistic downside scenario if both of those events go wrong?
Well, the analysis lays out what it calls a scenario 3 with about a 25% probability right now. And that's the perfect storm.
Which is?
A hot CPI print, which reinforces the Fed's hawkish stance, combined with an aggressive yen carry trade unwind after the BOJ meeting. If both of those hit at the same time, the S&P would almost certainly break below its 50-day moving average.
And then the VIX wakes up.
The VIX snaps out of its slumber, spikes above 20, and then you see that concentrated selling turn into much broader systemic fear. That's the real risk we're watching for over the next few days.
That perfectly frames the stakes. What a day. A masterpiece of divergence.
It really was a fascinating session to break down.
All right, I think that covers it. That's the daily consolidation for today. And remember, as always, this is all for informational and educational purposes.
Absolutely. It's not investment advice. You have to do your own research before making any decisions. But if you did find this helpful, go ahead and hit that subscribe button.
We're back every trading day right after the close.
See you tomorrow.